speaker to this 87th webinar on ESOP trending way of incentivize employee. This is organized by corporate professional as a part of his knowledge sharing, which we have started in 2020 when the COVID started. Friends, pardon me because I'm addressing this webinar from Barcelona airport. So some problem will be there, but I'll cover it. So given this hyper competition business scenario, rewarding the hard work and dedication to the employees necessary, and rewarding the employee with the stock along with monetary compensation would be sublime. ESOP is included, inculcate a sense of pride in the employee through a sense of ownership and the participation and the partnership in the company's growth trajectory along with their own wealth creation. Also, in today's robust startup ecosystem, ESOP are extensively being used as a part of growth, reward, and retention strategy of the companies. Though a well-designed ESOP scheme, the organization not only boosts productivity and drives the growth of business, but also reaps the economic benefit associated with a stock incentivized scheme and ESOP shares allocation, thereby fueling overall economic growth of any economy. The objective of this webinar is to discuss the benefit of ESOP and their impact on the financials of the company, the taxation aspects, the valuation aspects, both for the company as well as the employee, will also be deliberated. The key point which need to be kept in mind while this devising ESOP scheme will also be discussed. Today, we will discuss key areas of discussion in the webinar. So, ESOP life cycle, modes of ESOP implementation, ESOP in listed and unlisted companies, ESOP valuation, ESOP accounting, and taxation of ESOP. Friends, we have a galaxy of experts. I invite them and introduce to them. I'll just tell you that two speakers, Mr. A.K. Jain and Mr. Dipesh, both have implemented an ESOP scheme. And Mohini and Sanchit will discuss about the technical aspects, but these two learned speakers will discuss about what is the impact of ESOP scheme in their company. So today's our learned speaker, first Mr. A.K. Jain, who is over 4 decades of experience in finance, accounts, and general management of functioning, having worked with Mawana Sugar, A.F. Ferguson and Company, National Mineral Development Corporation in the past. Currently, he is the Director of Corporate Affairs of the company called Cosmo Phillips. It's a listed company. He holds a Commerce graduate degree from Meerut University and ICWA from Institute of Cost and Effects Accountant. He's also certified Information System Auditor from Information System Audit and Control Association, USA. I welcome Jain sir for this program.
Thank you.
Then we have a Dipesh Goskar. He is currently Company Secretary and Compliance Officer of Samaru Entertainment Limited, a listed company. He has rich experience of 14 years in the areas of corporate secretary and compliance function with listed company. He is member of the Institute of Company Secretary of India. Mr. Dipesh is commerce as well as law graduate from the University of Bombay. He has also qualified as certified CSR professional and holds certificate in Foreign and Exchange Management Act. Recently, panel judge at the Western Regional level of the competition conducted by ICSI. He has also been worked with the listed company in the field of textile, info, and aluminum foils. I welcome Dipesh for this program. Then we have Moni Vashni. She is a company secretary and she is in charge of ESOP insider trading services in corporate profession. He is partner in corporate profession and has been making experience of more than 15 years in the capital market and ESOP related things. She has developed more than 300 companies, ESOP schemes, and other advisory. I welcome Mohini for this program.
Yeah,
then we have Sanchit Vijay. He is a chartered accountant and he is a registered valuer, and he's a partner in corporate professional and managing the deal division and as well as the valuation division. So I welcome Sanchit for this program. Now, friends,
Thank you, sir.
today what we want to discuss, other than discussion, we have to do a very pleasant things today. We have recently came out our book on the company law ready referencer. It is so we want to release that book in the hands of uh, our Mr. A.K. Jain. He is a experienced professional, and it's a pleasure. Sir, I'll request you to release this book.
Thank you, Vijayji. It's a great honor and a privilege to release the book being brought out by a corporate professional. I'm sure this book will provide a lot of insight and result in saving of lakhs of rupees for the people by going through the book and finding the solutions rather than spending the money on consultants.
Thank you very much, sir.
It's my privilege to be an honor to release the book. Thank you. Wish you all the success with this new edition.
Thank you, sir. I will request Shivam, please tell us about the USP of this book. What is the unique in this book? Shivam Singhal.
Thank you, Pawan sir. Good evening to all of you. This is our new publication, namely Company Law Ready Referencer, which is yet another innovative publication from our house for corporate professions inside of Companies Act 2013 and the Handbook of Company Law Procedures. Book, now I am covering about the book, what is coverage under this book. These books have three divisions. Under division 1, there are more than 115 and ready references, which is a very quick reference of the relevant provision of the company law. For example, I am a member of a company and I want to see about my rights and liabilities in the company. Then there is a ready referencer about the documents and registers, which I can see in the company on the payment of fees or on a free basis. So there is around more than 115 ready referencer which can be useful for professionals. Then there is a division 2. Under this division, there is a section wise circulars for more clarity and quick reference. For example, from the starting of this Companies Act 2014, there is lot of circulars under section 135, and a user want to see all these circulars on one page. Then this book will help for that purpose. All these circulars under section 135 can be seen at one place. Then division 3, which is relating to drafting perspective, like board meeting and general meeting uh, draft and documents and formats of newspaper advertisement, affidavits, indemnity bond declaration and deeds. All our drafting is there under division 3. Now I'm telling about some key features of this book. All the ready referencer is in tables and chart forms, which is very useful and handy to read, and can refer to the relevant ready referencer instead of complete reading of the company's act. Book is divided into three divisions. You can see this: one division, second division, and third division. So there is a rainfall spot on the forage of the book. So user can go directly on that division 2 if I am want to see division 2 circulars. So I do not require to see the complete index. I can direct go to the division 2 with the help of the rainfall spot, which is on the forage of the book, and various draft formats for easy day-to-day professional work. This book is very helpful for practicing professionals, company professionals, directors, KMPs, students, and other stakeholders like members, creator, etc. Thank you, sir. This all about.
Thank you, Shivam. Thank you, Shivam. Thank you very much. And I just want to announce all the participants, those who wants to take this book from corporate professional side, we will provide 30% discount to them. Then what is the rack rate? So all the participants can avail discount coupon from us. They can write to us and we will organize this coupon, send it to you or book through this process. So this is our gesture. We want to help all professionals to do this. Actually, these types of books which we are doing research and coming out, it is a passion of corporate professional to do research oriented book, and that's why we are coming out regularly. Now, friends, over to the topic. Today, the structure of the program is like this. First, I will request Mr. Jain and then Dipesh. They will share their experience. Then I will talk to Mohini, request Mohini to give a presentation that what is the ESOP, how the ESOP will works. And then Sanchit will discuss about the valuation and we have a question answer. So anybody has any question, please write to us. We have received around 20-25 questions that we will cover. But you can ask any question. Friends, Mr. Jain and Dipesh, what we are expecting from you, sir, the basically we want to understand, though behind the introduction ESOP in your company, what is the thought process? Brief about the scheme which you have introduced or conveyed to the employee. Whether more than one scheme has been introduced, if yes, and what is the thought behind this? If you are bringing out multiple scheme, on what terms the scheme has been introduced, like the period, eligibility criteria, and other similar factors. How implementation of ESOP have proved beneficial in your company. Now, this is the last question, which is very important because everybody wants to understand that I want to do ESOP. What are the advantages? And friends, I'll just tell you, no doubt, the ESOP is popular with the listed company as well as the startup. It has started with startup, now has gone to the listed company. Now it has gone to the PSUs, but unlisted companies are not touched. They are having a question. So today's program, we will discuss that ESOP is applicable to all types of companies, even unlisted companies. And today, the cost of the employee, if you want to retain, then it is high. You can't get, if you pay peanuts, you'll get monkeys. That is the concept. So if you want to retain the better talent, if you want that talent should continue, you want to attract, then you have to bring out some better facilities to them. Now the question is, the better facilities connecting the money term, and it's a cost to the company, and the liquidity problems is always there with the company. This is one tool which can help you by not paying through the cash, but cash-like things, commitment of the management, instrument where the employee has a confidence. It is not a lip service of the company, but you can do something great and employee can get some pride feeling also. For unlisted company, the question is they are not going for listed. How can you benefit? So the buyback of ESOP is one system that you commit to employee. Either you go for listing or some other investor will come. Then you can share your investment, or you can bring out through the buybacks where the company can buy back if it is an unlisted company. Today we'll discuss all these issues and make sure there are so many professionals are here, those who are practicing. This is one area where HR people should consider whenever I'm discussing with anybody who is working internationally. The ESOP is a part of their system. In India, that is taking shape. Let's start with this. Understand all the issues, understand all problems, ask your queries so we can work out some scheme which can be win-win for all. Over to you, Jain sir. We want to listen from your side and we want to discuss.
Thank you, Pawanji, firstly for inviting me to today's webinar. I'm grateful and to you and the corporate professional for giving me the opportunity of sharing some of my thought processes with you and the participants into today's webinar. Okay. My sharing of thought process will be mainly from the management perspective, and only partially in terms of procedure and compliances. I come from whatever I'm going to share it out is based on my experiences at Cosmo Films Limited, where I'm presently working as the Director of Corporate Affairs. Cosmo's journey with the ESOP started way back in 2015, when we passed the necessary resolutions and took the shareholders' approvals to introduce the ESOP plan. There were 4 distinct objectives behind the introduction of the ESOP plan. First and foremost was to create an enhanced sense of participation on the part of employees in ownership of the company. 2 was to align the senior management team and the other employees of the company with the interest of the shareholders, and that is what we call it nowadays, maximizing the or optimizing the shareholders' wealth. Third was to provide an enabler for HR to hire, motivate, and retain the people. HR had been demanding it for quite some time. We deliberated upon it and finally decided to, thought it was prudent and important that we provide this much awaited tool to our HR team. And lastly, but not the least, it was also our objective to enable wealth creation for the employees. What I mean by wealth creation was that in our case, we gave the ESOPs to the people as an add-on and not in lieu of the salary. Unlike many of the startups where ESOPs are used as a means of compensation for their, you pay lesser compensation in cash and part of the compensation is paid it out in kind through ESOP. In our case, ESOP was an add-on compensation. We did not make any adjustment into the existing salary structure of the people, nor did we cut back anything on the future raises and the increments. So clearly the objective was that the ESOP should enable the people to create a wealth for themselves and more importantly, maybe for their families and the children. Okay. Then when we implemented the ESOP schemes through the secondary market route. We debated quite a bit about this. Should we go for the primary issues or should we follow it out the route of the secondary market, which at that time was introduced, I think, in 2015. It was already there in the statute book for about more than a year or so. So we find the secondary market route to be more beneficial, logical. It is anti-dilutive. There was no dilution into the shareholding of whether the promoters or the institutions or the retail investors. It is into that here. Yes, it required funding. Okay, unlike many other, unlike the many companies which adopt the ESOPs through a primary issue. Okay, and we didn't have any problem in terms of it. We had sufficient operational cash flows at our end, so we could afford to take out some money and put it in the trust for which was there to manage the ESOP purchases and allocation and grant to the employees there. Okay. And till now, whatever the ESOPs we have done it out, all of it has happened through the secondary market route. Okay. Let me, before I come to how the ESOP scheme of ours helped the organization in achieving its objectives, let me first describe it out a few of the salient features of our scheme. We started with the scheme at the senior leadership level. In the first grant was at the senior leadership level, and then gradually we went down and brought it down to the middle management level, which in the case of our company is the level of deputy managers, what we call it. Okay. But to start with, it was restricted to the vice president, general manager, deputy general managers, and not below that. Okay. Second issue was the coverage. Okay. Which are the employees which we should cover it out? We decided that the criteria which we adopted out should be transparent, easily understandable to the people, and free from personal biases. So we put in the criteria of one, the past service. We say minimum 3 years of the service should be there into the organization. Two, we put in the criteria of the future remaining service. We say the person should be having at least 3 more years of the service to go into the company. So we didn't want to give the ESOP as a parting gift or a retirement gift to the people. That was never the intent to that. Third was that within the select band of the people, okay, do we give it to everybody or do we give it out, differentiate it out on the basis of their performance? And we adopted the performance-driven criteria for the purpose of selecting the employee. And it was a transparent criteria. We said, we do 6 monthly performance rating into our company. We say your 2 consecutive ratings should be not below A, which means we have our rating starts from A plus and A, and then it goes down all the way to D. So we said that those who have obtained 2 consecutive ratings of A or A plus will only be eligible. So these are the criteria which we adopted for selecting the people. Of course, all this was done in consultation with the NRC, which was also designated committee for implementation of the ESOPs into that. And I must tell it to you that the employees were fairly satisfied it out with the criteria which we used in selecting the people. I did not hear around too much of a noise or cribbing from the people, oh, so-and-so had been favored and I have been ignored. We didn't get that kind of the feedback from the people. The ESOPs, next issue on the ESOP was that how much of the ESOP we should give it to the people. How do we determine the quantum? We decided to use a formula-driven approach here, and we said that okay, either it's a 1 year CTC or a 6 month CTC or a 3 month CTC, depending upon the levels of the people, and adjusted also to their performance rating divided by the ESOP valuation. We say if my ESOP valuation following the Black and Scholes formula comes to 150 rupees and I have got a person who has got say CTC of 30 lakhs, give him 20,000 ESOPs. Okay, as simple as that, we made it down. So that too was appreciated by the people. Okay, it is a transparent method. It is into that ESOP valuation is a verifiable valuation depending upon the exercise price and other things into that here. So we adopted this approach. In order to arrive at the numbers of the ESOP which we should grant to the individually to the people is, we need to first fix it up the exercise price. Okay. Quite a bit of debate in the boardroom and in the NRC. Okay, should it be 10 rupee or should it be something different? It is into that. And we had a very high-powered board, and the board said there is no way that you can grant the ESOPs at the cost of the minority shareholders or at the cost of the promoters. So we finally decided to give the ESOPs at market price, the market price prevailing on the date of the grant. Okay. So that is the price which we adopted it out for the fixing at the exercise price. We gave a 3 years vesting period. Okay, the vesting was straightforward at the end of the 3 years period, okay, not in phases, and there was no other criteria put it in except the passage of the time. The employee must be continuing it with the company on the vesting date. If he leaves it before that, he loses it out of his grant. While we put the vesting at 3 years, we were quite liberal in terms of fixing it of the exercise period. We put in a longish exercise period of the 10 years. And this fitted in well with our philosophy that one of the objectives of granting the ESOP was to the people to enable wealth creation. We say the longer the duration, better are the opportunities for the purpose of the people for the wealth creation. Then other feature which we introduced in our plan was that we said we are provided an option of cashless exercise. Okay. We say that on the date when the options are vested and you decide to exercise it out during any time of the exercise period, we say you inform to the trust will sell some number of the shares into the market, and deduct the exercise price, deduct the perquisite tax, and hand over the balance to you. So this was the full cashless scheme which we offered it out to the people here. For the people who were at the lower levels, it was very handy for them because they were looking it for the immediate cash in hand at the time when they are exercising the shares. One particular thing which is quite commonly known to all of the people is that yes, paying it out the taxes at the time of exercise rather than at the time of the sale. It has been a long pending demand from the industry to the Ministry of Finance, but it has not yet been accepted it out. I hope one or the other day the government will see a merit in the plea of the industry and accept the request for allowing it out the payment of the taxes or at the time of sale of the shares rather than at the time of exercising it of these things here. Okay. The unusual clauses were there in terms of the full vesting being there with the people in the event of a death, etc. These were normal provisions. It is there. So the scheme, we granted ESOPs in 4 different tranches into the people. And with the first, between first and the second tranche, there was a gap of about 8-9 months, and the second and third was about a year, and third and fourth another year into that. Unfortunately, in the initial period of after the grant, the share prices took a dip. In our case, the share prices went down below the exercise price, and there was a kind of a feeling among the people is, yes, what is this? Yeah, this is ESOPs have been granted it out, but they are like a piece of a paper, no good and other things. But that was the period when the vesting was yet to take place. Okay. As soon as the shares vested it out, ESOPs vested with the vesting period was there for the first tranche, we started seeing positive movement into the share price. Some of the people straight away jumped into that, and they said, yes, let me encash it out. I don't know whether this opportunity will come again or not. And as the later events have proved it out, the people who exercised it out, their ESOPs at the first available opportunity or the second available opportunity are the one who are repenting the most today. They are saying, what the hell I have done it out it. Okay, the company gave me such a wonderful opportunity and I have wasted it out in my, without applying it in my mind, and jumped it out on encashment right at the first go. Okay. Once the share prices started moving it into the market and our PE improved, etc. Okay, the people are seeing it a great value into the ESOPs which have been granted. I can tell it to you that the first tranche was at 300 rupees in our case. Second was at 350 rupees. The third one was at 250. Fourth was at 450 or something like that. Added into that here. So average was coming in about 350 or so. And today the price is 2,000 bucks. So the people can see it out the kind of the money which they are making it out. With the substantial gain being seen by the people, okay, and some of those who have cashed it out at different stages, receiving money in hand. So the real advantage of the ESOP we started seeing it now. Okay. One of the advantage which I am seeing it out is that in the last 1 year, at the senior level or at the, not all that senior level, but at the second level or third level also, we are seeing it out, no attrition. Okay, because the money at stake is pretty large. It is for the people. So the scheme has been operational with us for 4 years. It has brought in a lot of benefit. It's created enthusiasm for the people. I keep on receiving demands in every town hall from the people. When is the next ESOP grant is going to be there? Okay. So this was our experience with the ESOP. Now, after experiencing the ESOP, plain vanilla ESOPs, okay, we decided we introduce it out, a second kind of the ESOP, which is RSUs. restricted stock units. Okay. These restricted stock units were very different from the plain vanilla ESOPs. Here the price was the face value of 10 rupees. Exercise price is 10 rupees. But there are conditions attached with the RSU. The vesting periods are longer, okay, going it up to as long as 7 years. It is into that here. 2 is that there are performance parameters attached, delivery on performance parameters as fixed from time to time. And one of the parameters is delivering EBITDA numbers as per the budget or higher than the budget. It is into that. And then we also attach one very important restriction with the RSU. And maybe that we were the first one for putting in this kind of the condition. Okay. And this condition related to clawback clause. Clawback is that in case of certain specified circumstances, the benefit will flow back to the company. Company has a right to seek back the benefit which has accrued to you. And the clawback conditions, in our case, included it out, particularly with reference to the post-employment era. People are bound by the confidentiality clause. If there is a violation of a confidentiality clause, you better pay this money back to the company. Or there is a non-compete clause. Post leaving the company, if you go and join the competitor in breach of the competition, non-compete clause, which you signed at the time of joining and which was applicable to you, nobody forced that on you. It was your sweet will that you agreed for this clause. If you do violate that clause, company will not tolerate it without any nonsense into this front. The money will have to come back to the company. The issue came it up for discussion in the NRC was, in our case, how much money should come back? And the NRC took a view that let's get the gross benefit. Let the employee suffer or the tax which he has already paid at the time of exercising of the RSU. So we built it in, we say, this is a critical condition and this is why the RSUs are being granted it to you at 10 rupees. So nothing, it's not for charity. There has to be a quid pro quo, and we sought our quid pro quo by putting it in a clawback clause. Under this RSU's plan, we have only covered the senior leadership team. It is into that. It is almost 1.5 years that we are through into the RSU plan. First testing is yet to take place into this year. And this RSU plan is also being implemented by us through the secondary market route. Okay. On the secondary market route, I must also make mention that there is a lot of debate sometimes whether the secondary market route can provide an opportunity in unscrupulous hand to play in the market. I don't agree with that view at all, because there are enough safeguards which have been built in by the SEBI in terms of the year of quantum you can purchase in a year, the maximum holding you can do it out, the restrictions you can't do, the trading into the shares, etc. I consider that the secondary route is quite a viable route, good and in interest of the existing shareholders as well. Then third, we also tried it. We have also introduced a third variant of the ESOPs into the company, which has been done about 4 or 5 months back after the SEBI took out the cash settled SARs from the purview of the ESOP regulations. So we have made use of that and we have issued cash settled SARs into the company. And these have been issued at the lower and the medium level of the employees, the middle level employees of the people. These have been issued out at the current prices, and they will be settled over a period of 3 or 4 years, depending upon that. And whatever the appreciation comes, we will settle that into the cash here. We have yet to see. The initial enthusiasm to the SAR has been very, very encouraging from the people. And we also made sure in all the RSUs as well as in the SARs to maintain the confidentiality of the allocations. We didn't want A to know the allocations of the B. So when we granted the SARs, okay, there were 60, 70 people who were there into the company. And we wanted to communicate to them what is this animal SAR is. It into that, how is it going to beneficial to them? The issue was that if I do at a town hall or a conference, the confidentiality is lost. So I took individual calls with all the 60, 70 allottees or grantees to clarify it out, their doubts into that, or make them understand the SAR. It was quite a bit of an effort, but we feel that this effort was worth spent it out because the confidentiality has stayed back into the company. So this has been our journey. It is into this here. I will like, before I conclude it out, I will like to touch upon 2-3 issues which have been bothering it to us, and we still have not been able to find any satisfactory solutions to them. I'm sure that with the deliberations in today's discussions, with the learned speakers and the participants, maybe I will be able to get some better insight into the issue. It is one of the issues which is bothering it to us, and which started. This problem was not there before. This problem started 6-8 months back when SEBI amended the regulations from full cashless to the partial cashless. Okay. In the case of partial cashless, the trust can only sell the shares to the extent it is required to cover it up the exercise price and the tax. The problem relates to our employees of our overseas companies. Some of them are NRIs and some of them are the non-residents itself. Now, in their case, they exercise it out the partial cashless option route. We sold the part of the shares to cover the exercise price and this. The remaining shares, to give it to the employee, too many hassles. He has to open a demat account, he has to get a PAN number here, no objection at all. We went through that. Okay. The shares were credited to the demat account of the employee. Thereafter, the employee decided to sell them. He sold them, got the proceeds into his bank account. Now the issue came for repatriation of the proceeds. Okay. On the repatriation of the proceeds, nobody is clear, particularly with the RBI, what filing has to be done. Okay. Should I do the filing? That okay, there is no, in our case, there was no primary allotment involved. These were all secondary shares. No. So one view is coming it out is that you please file an application. RBI has been telling it to us that you please do the filing as if it is a fresh allocation. And the AD is telling it to us, if it is a fresh allocation, the money should have come from overseas. In this case, money did not come from overseas. Okay, there was no money required to be brought it in by the person. So it is 6 months now that we are struggling it out to find an answer to this question. In the meantime, the person who has sold it out, he needed the money. I had no other option but to give him an advance from the overseas subsidiary. I said, take an advance and meet your financial needs, what you have. We will try and get it this expedited, but no solution. Because AD and RBI are talking 2 different things. This is into that here. And we are trying to seek a meeting with the RBI and try and resolve that here. If someone can share it out, their experiences in this regard, maybe it will be useful to us here in tackling this problem. The second issue is I have been struggling it out, the gray area in accounting, with reference to the incorporation of the ESOP trust accounts into your accounts, particularly the P&L part of it. Okay. Dividend. ESOP shares held by the ESOP trust are eligible for dividend. Fine. Dividend goes to the trust. And the first thing the trust has to do is to pay the income tax. The money is of the company, paying it to the trust, which is an arm of the company, and you pay tax to the company. Okay, number 1. 2 is that the trust is buying the shares from time to time, and when the exercise happens, there may be a capital gain. Again, pay a tax on that capital. Should I take that to the P&L account? The tax? What should be the accounting? The guidance from the institute is not clear. At least not to us, it is not clear how the ESOP trust P&L has to be incorporated it out into the consolidated entities, particularly with reference to the capital gain and the taxes on that. Yeah. So these are the problems which we are facing it out. This issue remains unresolved. I do not know what purpose is being served it out by SEBI, allowing it out only partial cashless. The guy who has to sell it out, once the shares come into his demat account, he can sell it in the next 24 hours. You can't force the people to hold on to the shares.
It's very nice.
Okay, so thank you very much to all of you for listening me patiently into that, and I look forward to the increasing my insight from the rest of the webinar. Thank you.
Thank you very much, sir. Thank you very much. You have given a right insight of the ESOP in your company, and rightly you have pointed out some issues, gray area. We will discuss this issue in the question answer session. Now, Tan or Dipesh, please tell what are the advantages, why you have started, all these questions which Mr. Jain has discussed. Same, what is your experience? Dipesh, over to you.
So thank you, Pavanji. First of all, congratulations on you on the book launch and book release. So rightly you have mentioned in your introduction that employee stock option mechanism is not only helping company to build pay for performance culture, but also create wealth building opportunity for the employees. So I will tell about what is our company's policy, and we have whatever the experience I have, and etc. First, so Semaru is a 60 years old organization in media and entertainment space. And companies strongly believe that its success and performance are fully depend on its people employed. So our ESOP policy is built on the principle that people who create disruptive growth should be able to participate in the growth. ESOP also offers a sense of ownership, motivation, enablement to employee who put in efforts to achieve and go beyond their goals, so collectively achieve company's mission. So company has recently launched ESOP scheme for all the employees with intention to reward those whose exemplary performance support in deriving disruptive growth of the company. So from my experience, execution of ESOP scheme is more brainstorming and critical activity for its success. Many questions carefully needs to be deliberated before granting by the management, like how much quantum you want to utilize out of total quantum available for grant. In first year, you want to exert an entire quantum, or want to carry for next year, you want to keep for new joinee. If retention of the employee is the main intention, then how to divide vesting, whom to cover, kind of thing, how it can be lucrative for employees, also for company, how much discount one can give, calculation of compensation cost. At SEMAL, our eligibility criteria to cover employee categorized in 3 types. First, long service award. So those who have stayed with the company for particular number of years, ESOP granted to such employees as a token of gratitude for their service to SEMAL. Second is the leadership team who leads the revenue functions or different head of the company. So over there also, like performance link incentive can exchange with the ESOP, or whether this will be the add-on on the current CTC, or it will be the part of CTC. Then third is critical talent category, in which employee whose contribution are most critical to achieving this company's mission, like that way. So we have just recently granted the ESOP to the employees, and through the direct method only, because trust has many questions which we need to get answer, and it is also need to administrative and operational add-on compliance thing. So currently we have just granted. So benefit, we can visualize that retention, entrepreneurial behavior in employee, less cash outflow, reduction in employee costs, such kind of thing we can visualize. So still it is in just grant level. So that is what from the my side, not like AK Jain sir said. Yeah, that's it. Thank you.
Thank you very much, Thank you very much, Deepesh. Thank you. Now, Jain sir and Deepesh has talked about various aspects of how they are introduced there in their company. What are the advantages? Now, the question is in everybody's mind: what is this ESOP? What is SAR? What is this restricted scheme? All these things. So it is better to understand, and I'll request Mohini to explain this because Mohini has designed, she has designed more than 200 schemes in various companies, and she is implementing regular basis. And I was a part of the committee of SEBI when recently they have changed various rules, regulation, and Mohini was the instrumental in this. So I'll request Mohini to discuss this issue and give a presentation.
Yeah. Thank you, sir. So good evening, everyone. As we have, Jan sir has given us a very good journey of the ESOPs in their company, and he has given a very good view that how the ESOP first they have launched has been so a purpose which they have given this ESOPs have been fulfilled. So, and after the ESOP, they have come out with the 2 other variations. So one can think of that how once the ESOPs are being introduced in the company and the company is doing well and growing and sharing the wealth with their employees also give the same thing in return. That means a very less attrition rate, and as sir said, a 0 attrition rate at some level. So that's a good thing which the ESOP has served to the company and paying back to the employee in this. Also, one thing I want to add is that today is an International HR Day. So I think we are the human resource managers and human resource people are working for the employees. And today we have kept our webinar on ESOP. That means ultimately we are supporting them in that the employees are one of the important resource which need to be nurtured along with like the other assets of any company are. So with respect to this now for the ESOPs. So when we start with the ESOP, so first thing comes that definitely the companies who have implemented the ESOP, when you hear from them, you also start thinking whether should my company introduce ESOP or not. So before you jump into say yes, I just want to take you to the recent trends in the market of the ESOPs. So how the ESOPs are useful is, so if you can think, check one of the main important thing, that is the ESOP buyback. That means once you have introduced the ESOPs, the important thing comes is that, okay, I have given the equity, but how in an unlisted company? Listed companies are very much prevalent. Okay, it's a stock exchange where the one person can go and liquidate. But whether if I'm an unlisted company or a startup company, how I am going to be a liquidation for my employees? So the recent trend has shown that even the unlisted companies are creating the same kind of platform for their employees through the buybacks. So if we can see the data that the FarEye, Cashify, Wakefit, Cred, Razorpay, ShareChat, these have given the ESOP buyback recently. And it's the last 2 years we are seeing that the ESOP buyback has increased. That means the investment when flowing to the company, the founder, the management also giving the same respect to the employees, which the employees were exercising their ESOPs and paying them whatever they are paying to the company. And not only the ESOP buybacks are more, in the unlisted category and the startups, they are increasing their pool. That means as in the listed company, the employee, they are increasing day by day the coverage of their employees. Similarly, the companies, even in the unlisted sectors, are giving and increasing their ESOP pool to cover more and more into that coverage. So we can check that like Chayos, Potom, Urban Company, ShareChat, even the Paytm, even after the listing, they have increased their pool to cover more people into it. Even not only in the listed space, listed companies are coming out with the ESOP on a very frequent basis. So the companies are coming out with the first time as well, and even they are coming with the new variants of the ESOPs also. So when we think of, okay, we want to give an ESOP, so the first question comes for the person who has not even know that what the ESOP is. So first thing is that what exactly the ESOP means. So ESOP is simply an employee stock option plan. That means you are giving an employee an option to purchase a stock in the company, whereby they will become a shareholder in the company. So it's a kind of sharing the wealth of the company with the employees. So here, definitely everything we will be fixing today. That means whatever you are getting a stock in the future, at the price will be determined today, and you become a shareholder in the company. So in the ESOPs, we are giving a stock, the shares with our employees. So now it comes to that, if we are giving an ESOPs, why the stocks to be given? If I am paying the money to the employees, I am giving the commission, I am giving the incentives, I am giving the other kind of benefits and purposes to my employees. So why it is required that I should give a stock? So stock is a kind of an ownership feeling for the employees. When you are making someone a partner of your growth, that means they are getting the benefit of the entire organization growth, not only in my area. For example, if I in a service industry, I'm working for my company for a particular service area, but when I'm getting a stock, I'm getting the stock is the value of the entire company. So what I be getting is that I am working for the company, I have an ownership feeling with my company, and I feel motivated and help others also to build the company and create a sense of a belongingness for all in the company as well. So it's a motivation for the people when they get the stock. Definitely, the purpose is to retain and the key people, because what you can give, there is a limit you can pay in the cash. When you give in the stock, definitely he will be a part of yours. He will be the equal with your risk taking ability. So then the key employees and reduction in the attrition rate will be one of the things which is the important for the ESOPs when you are giving. Definitely a sense of ownership, and one important thing nowadays is additional deferred reward. So if we are giving anyone reward, definitely from the management point of view, if I'm giving an incentives to an employee, I want that the person should be retained for a long. So along with the retention, the benefits will be deferred, and ultimately this deferment of benefit is not only that the amount which you are deferring will be given to an employee, because it is linked with the stock. Ultimately, the deferred reward will be the wealth creation for an employee. So we can recently one of the survey has been done by the Session Capital. They have also come out with the report, and that report also shows the same thing. What is the objective of giving the ESOP? So they have very well come out that result that 92% ESOPs are being given to build a culture and sense of ownership. Next is the 87% is to retain talent. 83% is again to attract talent. Attract means to have a new joinees in the company, whereby we not be able to pay them in the cash salary. And then the next is 25%, again, a 1/4. That means to save the cost and increasing liquidity. So this is also now the increasing the reason for giving the ESOPs. Now the next question comes for an startup, or that at what stage the ESOPs are being given. So here also it has been come out that the people, the companies should give the ESOP. The 40% are giving before seed, 46% at the seed round, 10% is series A, and definitely the 4% at the series B and onward. That means the first round of funding from a series A is the benchmark, because at that point in time, the value of the company get unlocked. That means the person who are with you from the initial state, that is before seed or at a seed round, they will be getting a good wealth creation once the series of funding start coming in the organization. So once the series of round are coming in the organization, your wealth has get unlocked. So the people who are associated for you along, you will be giving a more benefit if you're introducing it early. Now we have discussed that what ESOP are, what the objective of it, and whether I should start at a seed level or at a maturity level. And similarly, even in the listed companies also, one can think of that what would be the right stage of giving the ESOP. So that also in the listed company also, like in the in the startup scenario, we can think of unlocking the value will be at series once the funding will start in the company. Similarly, in the listed company, we can compare the same, that once you are at a growth level and you are growing to and you are expecting a more growth and more strategies you are planning in the company, it's better to start at that time, so that you will be giving the people a more wealth creation, a more wealth participation, if once you when those strategies will be giving you the results. So now the when you have thought of and you have decided, okay, we want to start with the ESOP process, the thing comes is, what are the different instruments are there in the ESOP? So ESOPs, in the Cosmo films, they have introduced ESOP, then they have talked about RSUs, they have talked about SaaS. So these are the variants of the ESOPs, types of the ESOPs are. So when we are covering the ESOPs, so we can divide the entire ESOP in two plans, like equity-based plans and the cash-based plans. So in the equity-based plans, we have the ESOPs, RSUs, that is restricted stock units, employee stock purchase, stock appreciation rights, which can be settled in the form of an equity, and the stock appreciation rights, which can be settled in cash. ESOP, so briefly, I just give you an review about these types. So ESOP is similarly a simple when you are giving an option to an employee that if they fulfill the some obligations, they will be able to get the stock at a future date at a predetermined price. RSUs are also similar like the ESOP's nature in India. In that also, the people are getting the restricted stock units today, and these units are convertible into equity at a predetermined price, which is generally in India is a kind of a face value only, because face value only. And once the those restrictions or those kind of conditions like loyalty or performance get achieved, the employer will become eligible to apply for the shares in the company. So it's a kind of an ESOP, but definitely RSUs are generally be given to the linked with the loyalty and the performance of an employer. The second, the third one is an employee stock purchase, whereby we can say that in the employee stock purchase, there's no option per se that in the future, when you perform up to that level or you will stay with the organization, then you will be getting the equity. In the stock purchase, we offer the equity immediately to our employee, and like an offer, employee, if is interested, he has a complete faith of investment in the company, the employee will immediately subscribe that equity and hold it for the wealth creation. So it's immediately you are making the employees a partner with you. When we come to the stock appreciation, right? So by the word appreciation, we are talking about that the difference in the value of a company from the date when you are giving them those units. That means you are making them or promising them to become the partner in the company. And when they actually subscribing that equity, the appreciation, whatever they have earned over this time period, which is in any case is a minimum period of 1 year, and that appreciation will be given either settled in the form of equity, or it will be settled in the form of a cash. If we are settling it in the form of a cash, it is called a cash-based plan and stock appreciation rights, or it's a very well-known term known as a phantom rights, which are being given to the employees. Nowadays, many new terms and terminologies are coming, and you are reading these words in the news as well, like the management stock option plans, partner stock option plan, advisor stock option plan, referral stock, teacher stock, phantom stock. All these are the variants of the ESOPs only. And if we are covering a particular category of the employees, so these companies, what they have done is, because for example, in the urban club, they have a very large force of people who are serving them from their professionals are serving them, like the parlor services, there are cleaning people, carpenter and all. So they want them to become the partner. They are not the employees per se, but they want them to become a partner. So they have offered them a kind of stock option whereby they are making them the partner. So in this kind of a stock option plans are also available. So these are the various plans which are being coming out for giving an stock option benefit not only to the employees but to the other categories who are also an integral part in development of a company. When we talk about an ESOP, so there are various stages or a life cycle must be known to everyone. So the stages are a very simple, and it's a 5 stages which you can see here. Like first is the grant, the second is the vesting is to be done. Employee will exercise, get the allotment and the transfer of shares, and last is the sale of the shares. The sale of the share is the point where the ultimately monetization is being done by the employer. When you are granting, you have to be kept in mind that first who all are eligible. That is the very important thing which you need to keep in mind when you are granting. So the persons who are the employees of the company exclusively working for you, they are eligible, and the directors of yours are also eligible. Even the employees of a foreign subsidiaries of yours, and now even in the listed companies, associate companies employees, group companies employees are also eligible. So you can give the ESOP.
E77.
Now then when it comes to the
E77.
so the persons who are not eligible, these are the most, so you have to keep in mind that the people who are belonging to promoter or belong to promoter group, they are not eligible, and the independent directors and the director, any director holding 10% or more, they are not eligible. When we talk about that, to whom the options are being granted, as for the market practice, the level of the employees are being covered under the ESOPs. So the companies are, there are 20% companies which are covering only the senior management. There are 52% companies who are giving the middle management and above, and 28% companies are giving to all employees. So we can see that the majority, from the middle level of management and above, the employees are being given the participation in the ESOPs. So when we are giving a participation and make our all employee eligible, or even in the level of the employees making eligible for the employee ESOPs. Now, what is the appraisal criteria that on the basis of which I be determining that what number and the quantity to be given to the employees? So those criteria are the designation, year of service, performance of an individual, performance in the department, and the employment other terms. Like when the person is joining, they have the other terms of employment which need to be kept in mind. And per se, one more thing I want to add here is any in the unlisted companies or the companies who are getting the funding, any kind of their agreement in the shareholders agreement part, where they have defined any terms for their ESOP. So that also need to be kept in mind when they are designing and deciding on the appraisal process of an ESOP. So when you are granting, simply what you need to do is you have to communicate to your employees through grant letters. Definitely you have to make them aware of that what ESOP is. You have to make them learn that what are the stages, what are the conditions they need to fulfill. You have to mention in that what the options they have been granted, with the price they need to pay, and any other kind of if they leave the organization, what will happen with their ESOPs. That all things need to be communicated at the time of the grant. And the authority which are granting ESOPs in the company is definitely the board of directors, and in all the listed companies, it's the nomination remuneration committee or a compensation committee with the authority to give the ESOPs to the employees. Once the employees are being given the ESOPs, definitely the employees, generally it's not legally required, but the practice is that the employee should read the entire paper. If they have any doubts, they clear it from the HR or the team who is the owner of this launching of this ESOPs, and then give their acceptance to the terms of the ESOPs which have been given to them. Now, if I have given the ESOP, management has given the ESOPs to you, so they expect something from an employee to fulfill. So those conditions are known as the vesting conditions, because the right to convert those equity only come when you fulfill those obligations. So these conditions are the vesting one. So vesting can be a graded one, or it's a one-time vesting as well. So both are prevalent. The graded means that whatever you have granted, the right will come, or the vesting will come in tranches over the period of years. And a one-time is straightforward. For example, you remain in the organization for 3 years, And if you be there on the third year, definitely everything will be given to you, whatever is granted. So this is the one-time vesting. Again, when you are giving the, so with respect to the time, it's a graded or a one-time. The other conditions which you can put in the vesting is either the performance or a time-based. Time-based, as we have discussed earlier, that graded or the one-time. But in the performance, that means along with the time, we can put the condition of the performance. Individually, you have to attain that target. Or like in the RSUs, you have to complete that project within that particular timeline. Then you will become eligible for the ESOPs. Otherwise, you will lapse your whatever the options have been given to you. So the conditions which are prevailing in the market with respect to this vesting of option is that generally the companies are giving only the 1 year vestings is a 4%, 24, 2 years, 10%, 36 months, that means 3 years, 35. And the maximum, the companies are giving a 4-year time period of the vesting for the ESOPs. Once the ESOPs right get vested to an employee, the next comes is that employee has to exercise now. If he is not exercising it, then he is lapsing, he's losing the benefit which has been given to them. So he has to exercise, and at the time of exercise, he is getting the shares. So exercise again, in the listed company, it's a time-based generally, because there is all time an event is there, they can go and sell in the market. But in an unlisted companies, we can have a event-based exercises as well. When an employee is exercising, he needs to give what he needs to give to any company is he has to make an exercise application. They have to pay the exercise price. They have to pay the taxes, because the first point of tax, which I cover later on, that first point of taxation will come at the time of exercise. They have to pay the taxes, and if any other charges are there, they need to pay that. So at the time of exercise, employee has to pay to the company and can acquire the shares. When the employee apply for the equity shares against those options which has been vested with them, the company will be going to transfer those or allotting the shares to the employee. The company can have the two type of two ways to giving the shares to the employees. So the first way is that they will be going to allot the fresh equity shares from them, their kitty, and another way is that the secondary acquisition. That means already whatever the issued capital is, they can channelize those capital as well to the employees. So that it is equally applicable for the unlisted as well and for the listing, both one. In the listed companies, they can have the fresh allotment even, and if they want, they can channelize through the secondary market acquisition route as well. In the unlisted company, similarly, if they want, they can have a fresh allotment, and in case a fresh allotment not be there, they can also, any investor, if they want to, or any promoter want to give a part of their holding to the employees, through that already issued capital, they can transfer those shares to the employees. Now, once the employees are the owner, they are the shareholders, they have the shares in their hand, they have invested in the company. So the opportunity to liquidate those shares also be there in the ESOPs cycle. So when the employee will be selling the shares is in the listed company case, definitely the employee can go and sell on the recognized stock exchange at the prevalent price, whatever the fair market value, the market value is running on the exchange. They can simply go and sell those shares. And next is that in the unlisted companies case, generally the liquidation will be provided on the liquidity events. The liquidity events are like any first and the foremost is definitely a listing of the company. There is any change in control, the promoters can purchase, new investments are coming, buyback opportunities being given by the existing employees or the promoters, or any other event as the company may come out for the liquidation of their employees. And we have seen in the first slides of our today's presentation that the companies nowadays in the unlisted area also, they are giving the exits to their employees. The thing which, so this is the life cycle that from the grant to the sale. The next question comes up in the life cycle is that when we are granting and the employee is exercising, what the price to be paid and what the price the company should keep for an employee at the time of the grant. So the exercise price can be based upon the market price, the face value of the shares can become an exercise price. You can give a discount over the fair value of yours. Fair value means whatever the market value of yours is, on any other price which you can arbitrarily select by the company. In the listed companies, when we talk about the market price, generally the exercise price is based upon the 1 day prior to the meeting in which the ESOPs are being granted. On that base price, any discount up to the face value we can give. And in the unlisted companies, definitely the market value will be determined by the independent value. How this pricing will be done, how these pricing will be calculated, all these will be covered by my team member, the team subject, who will going to explain you in detail that how the valuations being done for the deciding and determining the exercise price, as well as for the other accounting aspects and taxation, which I will be covering now. Important thing in the entire ESOP are the two things, which is not this life cycle of an ESOP is, but an important integral part under the ESOP are. The first is the taxation. So the important point and always time and all time the organization, the employees will come. If I'm paying only the exercise price, or I have to pay something, and is there any taxability on ESOPs? So yes. The first thing is no taxability on the company, but the taxability is in the hands of the employee. So there are two points of taxation under the ESOP. One is the exercise and another the sale. In the simple terms, I try to explain it that at the time of exercise, which is the first event when you're acquiring the shares and converting your options into equity, whatever is the difference of yours from the market value at the time of exercise is a kind of a perquisite in the hands of an employee. It will be added into the salary of your that particular month, and you will be taxed in the bracket, individual tax bracket, wherever you are falling after adding this perquisite value. So this is the first time, the first point of tax where you are paying when you are acquiring the shares. Now you are the owner of the shares. Simply income tax says, and all are aware of, when you are selling your shares into someone, either in the open market, in the listed companies, to an investor in an unlisted companies, then at the time of sale, you need to pay a capital gain for the difference value which you are getting over the market value when you have exercised. So that means you are paying the tax over the whatever the benefit you are getting at the time of sale. So these are the 2 points of taxation which you have, which is there in the ESOPs. But in the case of a phantom schemes, you will be taxed only at one stage. The reason is here at the time of exercise, no shares will be given to an employee. So he will be given only the appreciation in the form of a cash. So from that cash, the tax will be deducted and the net amount will be given to an employee. And when you are giving an equity, definitely the employee will be taxed twice. So it's an example which I've explained that what is the difference will at the time of exercise will be taxed under the head of salary, and the difference at the time of sale will be taxed under the head capital gain. And capital gain, again, it's a long term, short term, depending upon the holding period of yours of those shares. Now it has been taxed in the hands of an employee, but another part of it is that the company who is giving and offering these ESOPs to the employees. So when the company is offering the ESOPs to their employees, it's a kind of a benefit which they are giving. It's a compensation cost which they are incurring for getting the service of an employee. So the value of the benefit which they are passing on to the employees at the time of the grant is a compensation cost which they need to book in their books of accounts, and they will be treated under the head of compensation cost, and it is allowable expense under the income tax as well. And how this accounting value is to be? So accounting value is regulated through the regulatory framework as well in India. So we have an Ind AS 102 for the companies who are having the Ind AS applicable on them. And if the companies are not covered under the Ind AS criteria, then they have a guidance note 18 of Institute of Chartered Accountant, which they need to follow. As I explained, that the employee compensation cost is the benefit. That means at the time of grant, whatever the value of your company is and the exercise price which you're keeping for an employees, the difference is the exercise, this is the cost, and this cost to be booked over the vesting period. That means because over the vesting period you're getting the service and they have completed their obligation, so up to that time your cost to be booked in the books. And as I said, that's an allowable expense. There are many cases, lemon tree, and which has been settled by the High Court, and it has been allowed to be as an allowable expense in your P&L. So, and you please have a very appreciate that this kind of an expense is a notional expense only. It's not a cash expense. So this is the benefit which you are getting when we are talking about that. When you are giving ESOP, you are saving cost. That means you're paying, you're compensating, you're rewarding your employees, and still you are not giving any kind of cash liquidity to the employees from your end. So there is a cost saving, cash saving at your end, and you will be retaining your employees after giving the ESOPs. So now because we have talked about the accounting, we have talked about the income tax, we have talked about the exercise price. Here, the major role comes the valuation. So now I request Sanchit to please explain everyone that what the valuation methodologies are for the ESOPs. Yeah, over to you, Sanchit.
Thanks, ma'am. Hello, everyone. So we have covered in detail on how the ESOPs actually work, what is the vesting, how the grant happens, what are the taxation aspects. Now we would come on to the valuations for ESOP for accounting as well as tax purposes. So both for accounting of compensation expense by company and for perquisite tax payable by the employees, the valuation plays a major role. So if we first look into the accounting aspect of the valuation. So in accounting aspect, the valuation is required for working out the employee compensation that is at the time of the ESOP grant. And whatever the valuation expense that comes out to be, it is apportioned over the vesting period of the ESOP. For doing this valuation, there are two methods. First one being an intrinsic value method and second one being a fair value method. Next slide, please. So let's first talk about the intrinsic value method. So in all reality, intrinsic value is a basic plain vanilla method to determine the excess of market price of the share under the ESOP over the exercise price of the option determined by the company. So if I would like to give you an example, a company wants to grant an ESOP to its employees whose current market price of the share is approximately 100 INR, which is to be exercised after 2 years, for which they have determined as 60 as the exercise price as per the screen. In this case, the intrinsic value of the option shall be INR 40. That is subtracting the exercise price from the current market price. However, if in this case, where the exercise price was 60 and the current market price was 70, there would be no intrinsic value. As the intrinsic value cannot be lesser than 0, in this case, the exercise price is more than the current market price and the employees won't exercise and it will be lapsed over the period of time. So intrinsic value doesn't account for any of the factors. However, to rope in this problem and to plug in this issue, there is also a method called fair value method. So fair value of an ESOP is calculated using an option pricing model. A few option pricing models which are being globally accepted are number one being a Black-Scholes model and second one being a binomial model. For performing valuations of ESOPs as per the option pricing model under Black-Scholes, we take into account various factors which were not taken into account while doing the intrinsic valuation. So like time value of money, interest rate, volatility, dividend yield, all of these factors are considered while doing the valuation for Black-Scholes. To go in a little detail on how the Black-Scholes methodology is followed, it considers various external factors that affect the value of ESOP, which intrinsic value fails to consider. Some of the methods that we have to take into consideration while valuing options through Black-Scholes methodologies are expected life of the options, the exercise price, the fair value per share, expected volatility of the share price, expected dividend yield, and risk-free interest rate. In these factors that I've just told you about, the fair value of per share is determined by the equity valuation of the company. Expected volatility is calculated by using a peer and taking their listed share price as a benchmark. And so do we take into consideration the risk-free interest rate as the 10 years government bond rate. Next slide. This I just talked to you about was the accounting valuation. So both the valuation that happens, first one being the accounting valuation and the second one being the tax valuation, happens at a different stage during the ESOP valuation. The accounting happens at the exercise of the grant, and the tax valuations is determined as a perquisite tax payable in the hands of the employees as per the Indian Income Tax Act. If you go into the clauses, so it is as per the clause 6 of subsection 2 of section 17, the fair market value that is calculated for security or sweat equity shares. There's no such method being provided for the unlisted companies, this also includes the companies listed on overseas stock exchange as well as the overseas exchanges that do not qualify as recognized. Next slide. So as I was telling you about when these valuation takes place, these happens at two different stages of ESOPs. The valuation that I talked about for accounting purpose is usually an accounting entry that happens at the time of the grant of ESOP. Accounting valuation is required for working out the employee compensation cost, which is to be apportioned over the vesting period of the ESOP. So this is primarily accounting impact that we have, and that is why we require the valuation for it. The second aspect is valuation for the perquisite tax. This is required at a later stage. First, we get the accounting valuation for accounting done, and then at a later stage, when we are determining the value of the perquisite that is taxable in the hands of the employees at the time of exercise of options for the employees, that is when perquisite tax valuation is required. The perquisite tax valuation is required by a merchant banker, and which is to be done at the time of the exercise of the options. So these are the two valuations that are required at different stages. And as corporate professionals, we would be happy to take any questions that you have with regards to ESOPs, whether it be granting, vesting, or valuations related. And yeah.
Okay, thank you very much, Sanchit, for giving the insight of valuation, and thank you, Mohini, for giving a very extensive and very effective and useful presentation with comparing with various companies. Now, time to question answer. I have received various questions. So, Mohini, I will start with you. What is the difference between ESOP and RSU as envisaged in Company Law Committee 2022? Under both, I'll just repeat. Under both, employee get the entitlement to share at the end of the vesting period. In the case of you, additionally, after condition of the duration of employment and performance parameters are met. Is there any other difference between the two methods of implementation, valuation, accounting, taxation? Mohini.
In India, if we talk about the ESOP and RSU, so per se, we also not found any difference in the ESOP and RSU, but only the difference is the thought process and the reason for granting those ESOPs and RSU. But if we talk about the procedural aspects of it, and the kind of exercise price which they are talking 10 rupee or the process, so there is no difference per se. Definitely the committee law which they are amending, they have come out with the thing that they are coming out with an RSU as a different name in the ESOPs category as well. So we are also looking forward that they will be creating some kind of a difference in the ESOPs and RSU in terms of the allotment to an employee. Because if we talk about in the foreign countries, RSUs immediately get credited in the employee's account once they fulfill their obligations. For example, their projects are completed or their tenure is completed, it will be immediately credited. But in India, we don't have any kind of an immediate credit. the company employee has to exercise. They have to pay something and then they are acquiring. So we also expect that they will be coming out with some kind of same kind of a methodology for RSUs, but it's not clear per se that what they are coming out. I think Jan sir can explain on. They also have implemented the ESOP scheme. RSUs.
Jan sir, you want to say anything?
No, but Moni has explained it very well, and she covered all the points on this issue.
Okay, sir. Is employee stock purchases market price or a discount? Jan sir, Moini, Deepesh, anybody can give answer.
Sir, I give you the on this that
market price or a discount.
Sir, when we are giving the employee stock purchase, that means I am offering the ESOPs or equity to an employee immediately. So definitely, if I be giving at a market value of today to an employee, it will not serve a purpose. Definitely, whenever any ESPS scheme is coming, it will be at a discount price.
Okay, Deepesh, you want to say anything?
Nothing.
Okay, Moini, in the case of private limited companies, since shares are not traded, how will the employee encash the stock option?
Any investment in coming in the company, the management and the founder, even the investors are ready to give the exit. So nowadays, buyback has become a very prevalent method for the exit for an employees in an unlisted companies as well.
Sir, are you in favor that unlisted company can do buyback and they can give the same and create same enthusiasm the listed companies creating?
It will all depend upon the methodology which is adopted for determining the buyback price. As Mohini covered in her presentation, if it is linked to the liquidity event, the people are happy because someone else is doing a valuation, there is a transparency. Otherwise, there is always a doubt, yes, ये 10 रुपए, ये 200 रुपए हो, 400 रुपए हो.
That's right.
Because
so here you have
as we all know that valuation is not a science, it's an art. Okay.
So it means, sir, the valuation of listed company is a market driven, but here you have predetermined formula or on the basis of your doing.
Correct.
Okay. So Moni, have you an experience doing this valuation of the buyback of the unlisted company?
Yes, we are doing the buyback, this valuations for the buyback as well. So definitely, generally the buybacks are being given. If not an liquidity event is there, the market value, the fair market value at that time will be determined. And generally, we have faced and we are advising the companies to give the buyback on that price which is running at that time, so that it will be a fair one.
Okay, Mohini, if the company has already made grant under old regulation without obtaining in principle approval from exchange, and after new regulation came into force, the company is applying for a principal approval. In this case, do company needs to ratify the grant already given?
No.
Or an RC or need noting an annual report?
No, if you have given, because this amendment has came only in August 2021. So if you have given any grant earlier to 2021, no requirement of a ratification, because that's not there in the law that before grant you have an in principle. But now it's the condition. So whatever the grant, even in the existing scheme you are giving after 2021 and you have not obtained the in principle approval for that portion of capital which you are granting. So you first obtain your in principle and then you grant. This is the
okay. Deepesh, in your company, what Mr. Jain has told that there's no retardation now. Have you seen any biggest advantage that people are not leaving company because they are getting advantages in the valuation?
So we have just granted the ESOP. So definitely they are after granting the share price go deepen. But the vesting is for the 3 years, so definitely they are going to, and companies on the growth trajectory, maybe definitely they are going to. So right now they are positive, so we are believe in the these things.
Okay, Moini, what kinds of shares are given to the professional from Urban Club? Is this given under X number of years of service be given in this case?
nothing per se there in the market that how they have given. Definitely they are making them the partner for the contribution they are giving. So definitely the person is associated with the urban club in terms of when they are giving the services, they are offering the options to those associated employees.
Okay. Sanchit, what are the problems you are facing when you are doing valuation of ESOP? It's a vanilla Black-Scholes model or something, some unique thing you have uh, faced when you are doing valuation?
So actually, in the case of listed companies, doing the equity valuations is fairly easy. The Black-Scholes model is a more formula-driven method where we have to adjust for various factors like risk-free rate, volatility, and everything. So in that sense, there's no problem as such. It is only the decisions that the company has to take with regards to the exercise price and what is the exercise price that they're trying to create, what is the underlying price of the company, because there is where a discord lies, because the company expects a certain price of their company. However, the equity valuation doesn't give that price. So that is the only issue that we face. But again, that's again very a subjective one. We always give our justification when we do our valuation for whether it's Black-Scholes or equity. So in that sense, it's a very smooth going process from here onwards.
Okay. Jen sir, can an employee sell the shares immediately after exercise of option or need to hold for some time? What is the scheme you have designed?
In our case, the employee can sell it out on the same day. There is no holding, there is no lock-in period. We have prescribed it out. But there are some companies which prescribes a lock-in period. But generally, I have not seen the lock-in period in the case of the vanilla ESOPs or the RSUs. But in case of the employee stock purchases, share purchases, the people put in lock-in period.
Dipesh, in your case, what is, you have any restriction or I can sell directly?
No. Very next moment after the options, whenever shares get listed, employee can sell.
Moini, in your, you have designed various scheme. What is your, any company is prescribing the restriction?
No, nowadays no company is prescribing, because the important thing is the cash outflow from an employee side is very huge nowadays when they are exercising. So generally the employees need to cover those kind of investment they are making. So generally the processes that the employees are selling a part of that shares which they require to cover the expenses or the cost they have bear. So there is no lock-in process.
Okay, Jen sir, you told that we are plowing back. Suppose a employee is exercising and then selling shares and then leaving the company. So what is the protection you are doing?
There is no security or a pledge being taken by us. But if there is a breach of condition, then we have our civil remedies available to recover the money from the employee.
Okay. Moini, suppose my vesting period is 2 years. How accounting entry to be made an impact on Companies Act?
So the formula for an accounting is that whatever the cost of your is there on the grant date, that need to be booked over the vesting period. So if in your case it's a 2 years time period, so the entire cost will be booked in these 2 years time period. So you have to book over the vesting period. So it's a 2 years accounting period which you need to take care of when you are booking your cost.
Okay. Jen sir, a very interesting question. What are possible scenario for exit employee to exercise vested option in case of a non-listed company with no EB trust? No employee benefit trust. No employee benefit trust.
Yeah. In case of the unlisted company, the issue is that how soon we expect the liquidity event. That is a critical question. Okay. And generally the people will hang around into the company till the time the liquidity event is there, or the company has made an arrangement. I'm told that some of these new generation companies where the promoter set it up a parallel arrangement for buying back the options from the people. It is into that. Otherwise, the people keep the shares with them even if they leave the company, and they hope there would be a liquidity event and they will be able to encash from there. So, I mean, in the case of the unlisted, you are always dependent upon the management.
Moni, you are able to hear me?
Yeah, yeah. One thing I need to add in this is nowadays there are many companies who are providing the exits to the employees, like an unlisted cart are there, Rura's Fin is there, who are providing a kind of a platform for the unlisted employees as well, that they can through which they are providing the channel that any HNI or any investors are there. They are the public limited companies. If they are interested, they are providing a kind of a channel to them. So this is also one of the way nowadays it's being developed in.
Right, you are right, absolutely, Moni, because the unlisted shares are also being traded into the certain platforms, and
Yes.
that platform, the only source of the shares is from the ESOP route.
Right, right.
Yeah.
Right.
Moni, in case of unlisted company, can ESOP be granted at market value? For example, if face value is 10 and firm is fair market value is 12, then can we grant ESOP at 12 rupees?
Yes, market value is definitely a value at which you are you keep as an exercise price, because nowadays the companies is saying when I am any person other than you is investing in the company, they are investing at a market price.
Yeah.
I am making you a partner today. That means you are becoming a partner in the wealth creation from today's date. So market price is a very good price to keep at that.
Yeah.
Sanchit, do you have any different view?
No, I think I have a similar view.
Okay. Which compliance is required to be done with RBI FEMA at the time of grant to overseas subsidiary employees? Sir, I will ask you, Dipesh, because you must be having some employee and Jensen. So what are the compliances you have to do, and what are the problem you are facing? One problem you have already told in the in your address. What are other?
At the time of grant, there is a standard format form. I don't remember the form initials that has to be filled in and sent. Okay. My only issue into that form is that form was designed it out when there was no secondary market route, frankly. With the secondary market route coming it in, most of the information into that form is really redundant. But nevertheless, that form has to be filled in. And if somebody slips up in filling in the form, RBI is taking quite a liberal view. They put in a token compounding fee and let go.
So form ESOP has to be submitted to AD.
Yes. That is at the time of grant. And at the time of an exercise, there is another form which has to be filled in, which is normally to be filled in if the shares are being allotted to a non-resident. Okay. And but if there again, issue is that if it is a secondary market transaction, as has been in our case, that form doesn't have a space for the secondary market reporting.
So nowadays, generally, the companies are giving the at the time of definitely on the ESOP grant, ESOP form is there, but at the time of allotment, FCGPR, whereby the capital is increasing, and if it's a trust route, generally the ADs are accepting the FCTRS or so.
Correct.
Okay. When is it prudent to restrict the right of employee to avail more beneficial employment option by granting ESOP that will be vested over a period of time?
Definitely, sir. When we are giving an ESOP, it's a retention. So if I have given I have given the ESOPs, the value of the company is increasing. Definitely, if the person is not able to bargain that value from the other company, the employee will be there in the company, present company itself.
Okay. Moini, when the company buyback at a valuation on the date of encashment, then how the accounting of shares premium or discount will be done? Secondly, if the promoter don't want to buy at a higher price, what recourse is open to the employee? Because we are promoting the unlisted companies ESOP. So in these types of problems you can face while granting and doing an employee has this problem.
So this problem can be met out with respect to the price, buyback price by the promoter is that in your scheme itself, we can very well mention the formula, right? Like the fair market value at that point of time by an independent value. So it's not that. And when an independent valuer, like the Sanchit can also add into, when they are valuing the company, they are asking for the projections. And I believe that if a company is giving the projections to bank, the same projections or any other private equity venture for getting the capital, the same valuation, same projections they need to give for the ESOP valuations as well. So presently, nowadays, the companies doesn't create any kind of hanky-panky valuation projections only for getting the ESOPs. So I think today in the present market, present scenarios, even the buyback by the promoters should be at a fair value.
Okay, now I have a few more questions, and so I will start rapid round. So everybody has to give very short answer. Moini, is it necessary to compensate the option holder by issuing additional grant at the time of bonus right issue?
Yes, you have to give a corporate action adjustments in case you are coming out with a bonus, split, or a rights issue.
Okay. Deepesh, it is mandatory for get prior approval from the shareholder for issue of more than 1% grant to the employee. If it is not done, can it be ratified later?
Yeah, can with special resolution, yes.
Okay. Jen sir, can a trust purchase shares through secondary acquisition during the closer trading window?
No. When we have been following that principle that the ESOP must follow, buy it out when the window is open.
Sir, is yes. Adding to sir is that important for all that trust is bound by all the prohibition of insider trading regulation as a promoter is bound. So trading window closer, trust also cannot buy from secondary market.
Okay. Is there any restriction on the exercise option during window closure or while being in possession of UPSI in the context of PIT regulation?
No, very simple. Exercising of ESOP, no restrictions, even during trading window closer, and you are having any possession of UPSI. But the restriction is on selling. You can't sell in those two circumstances.
Okay. Jen sir, you have a foreign employee also. Can foreign national be given ESOP?
Yes, there is no restriction.
Okay.
There is no restriction.
Okay. Deepesh, can a public company give ESOP to executive director?
Yes, if he is not in the promoter group.
Moini, can LLP give ESOP?
No, because it's in the corporate shares are required, so LLP can't become eligible.
But I can make a different scheme of LLP where I can make
any kind of phantom schemes we can introduce.
Okay. Okay. Can a company give ESOP to employee every month as a part of salary?
Yeah, it's up to the company's policy.
Technically, yes.
Okay. Okay.
Vesting the start
okay. Variation on ESOP. Can ESOP be cancelled if employee resign after grant?
All the invested part of the ESOPs get lapsed once the employee resigns. So
okay,
no cancellation.
Sir, Deepesh and Jain sir, you have any different view?
No, same. I agree with the Moini completely.
Okay. A company grant option and wants to change the period of exercise from 2 years to 3 years. Can it be done if it is where the shareholder resolution is required? Moini?
In case of variation of already granted terms, nothing can be changed until unless it is in the beneficial interest of the employees. So if you're increasing the period, if you are approving that it's in the beneficial interest through shareholder approval, you can definitely change.
But if it is not beneficially, even
shareholder approval cannot. You can't change.
Sir, have you faced this type of problem?
No, we didn't have this problem at all. And even if this problem was there, we would have solved it out by ensuring some other adjustment so that it is beneficial to the employee. Give them the additional, something additional shares or additional.
Okay. Okay. Deepesh, is ESOP shares of unlisted company be transferred to others? Anybody, Moini or Deepesh?
Yeah.
Yes,
Moini, you can tell.
Companies, unlisted, if your shareholders agreement allows so, you can do so.
Okay, one person has asked the question. My question is still remain unanswered. Share premium or discount accounting and option to employee if promoters cannot buy back. So I think if the promoter is not buy back, you have a civil remedies. Then, sir, am I right?
Yeah. In the case of an unlisted company, the promoters normally set it up a trust, or the company sets it up a trust, and the buyback happens it's out by a trust. So they remain like a treasury stock.
Yeah. So you can go for civil remedy and you can ask because
Yeah, that is, you will seek a specific performance relief.
and sometimes the company is saying I will pay you 100 rupees, but in place of 100 I will give you 70 rupees cash and 30 rupees ESOP. So that is a farce. So
No comment, sir. No comment.
okay. Okay, so that way you can do. Okay, now money exercise price, can ESOP be issued to the employee without paying any exercise price?
No, in India, it's not. You can't issue the shares at a 0 price, at a discount.
Okay, this Moini or Sanchit can give answer. Is the employee required to pay any tax or difference between price available prevailing on the exercise and the date and strike price?
Yes, first point of tax is on the date of the exercise. So they have to pay the difference between the strike price and the market value.
Okay, and Moini, tax implication of ESOP on the company?
No taxation, no tax to be given by the company because already employees paying the tax over that value. Company is in getting the deduction for that.
Okay,
Yeah.
what is the tax implication to ESOP on the company? Sorry, what is the cost which company is required to book when giving the ESOP to the employee?
Sanchit?
So at the time of grant, they'd have to calculate the fair value of the option, which is to be apportioned over the vesting period. So that would be the cost to the company.
Okay. Can the company keep restriction on sale of shares in the hands of employees? Yes, sir.
I mean, depends upon the lock-in period, sir. I mean, which is out of fashion these days. Nobody puts in a lock-in period.
One thing I need to add in this is that in the case of an unlisted companies, generally the offer right, first right of refusals are there in the hands of the promoters for selling the shares in the market.
Okay, Deepesh, a company has implemented ESOP to employee. The company wants to stipulate lock-in period of 5 years on shares as and when to be allotted to the employee. Can company stipulate a lock-in period?
So once it is granted, as Moini rightly said, without shareholders resolution, if it is not beneficial for the employee, cannot change. So after grant, it is not, I think we can change, but before grant or if yet to be granted, we can change with the shareholders resolution.
Then, sir, can the vesting period of 5 days or 1 month in case of listed company?
Yeah, I mean, there is a 1 year minimum, which is specified by the SEBI. After 1 year, then you are free to fix the vesting period.
Okay. Moini, can we issue ESOP without vesting period?
No, vesting period is always that is an option. Yeah. If you want no vesting period, you have to go for the employee stock purchase plan.
Okay. Buyback of ESOP are permitted under which regulation?
Buyback of ESOP, that means option cancellation. Companies Act also have the provision. Now in the company law committee, they have also recommending some kind of a buyback provisions are there. And the SEBI in their regulations, buyback regulations has also mentioned this about the option buyback. But otherwise, this purchasing the shares by the investor or the promoter is also nowadays known as a term of a buyback.
Okay. Is it prudent to restrict the right of an employee to avail more beneficial employment option by granting ESOP that will be vested over a period of time?
Already replied, sir. But Jan sir, if can add.
Yeah, it's already replied.
Okay. Sir, can some smart individual outside the company buy ESOP component of shares from unlisted companies from the employees after the lock-in and other related rules? Sanchit, you tell, you have purchased some shares of ESOP of unlisted company.
So I didn't purchase ESOPs, but yes, I did purchase shares of certain unlisted companies, but they commit to the lock-in.
But ESOPs are generally non-transferable.
Yes,
ESOP is specific to the individual and no rights of transfer are available.
Okay. Last two questions. Can promoter dilute their stake by way of transferring shares to the employee in the form of ESOP without issuing fresh shares?
In the route of trust.
Okay. Sir, have you experienced this?
No, we have not experienced it without this because we have been buying it from the secondary market. But if in the secondary market, the promoters are also participating, it's so be it.
Okay. Sir, if you give ESOP to employee of the foreign subsidiary, holding company has to recover the cost of ESOP from subsidiary company?
Yes, as per the Ind AS, yes.
Okay. Moini, whether the cashless exercise is permissible beyond sale to cover under trust route?
No.
Presently, no. As per the new regulations, no.
Okay. Is it necessary to company to amend their existing employee stock option in the line of provision of SEBI Regulation 2021 before granting fresh option under existing plan, which was framed under the pre-amended regulation, and the in principle approval were also obtained from the stock exchange?
If there is not, if no clause of their of your scheme is in contradictory to the present the new provisions, then there is no requirement of ratification.
Okay, Jain sir, why the trust route is advantageous instead of regular routes?
It is anti-dilutive. It doesn't cause any dilution to the promoters holding or to these people here. And secondly is that we see the in the case of the secondary route, the company can time also. Okay. If when should it buy it out, there is a flexibility availability out over the period.
Is it merged with the normal paid up share capital to all the purpose of provision of Companies Act? If you have experienced this?
I'm
Sir,
not clear on the question.
Sir, I think you are, if ESOPs are being there, till the time it's not issued, no capital is there. No capital is there. Once it is issued, definitely it's a part of a normal equity share capital only.
Okay. Hello.
Yes, sir.
So now I have covered all the questions which we have received and which we have received yesterday also. If anybody has any question is not answered, please write to us. We will give answer. Now, before concluding this session, I will request, as per ritual, we are asking the impact of ESOP. So I will start with Jain sir, that what you feel, the ESOP, the process, how this is taking shape in India, and what change in the overall employment and employee empowerment.
The ESOP is becoming, ESOP is becoming the order of the day. There for the startups, it is a must have. There is no startup which can exist it out without an ESOP scheme, because they don't have the liquidity in their hands to pay the compensation in line with the market. So they use this as a tool for the deferred compensation. Okay. For the non-startup companies, established companies, again, it is becoming important to ensure that the employees stay with you. They stay with you with full loyalty and integrity into that. So wealth creation has to be ensured to this end. And we are seeing it out that it has made a huge difference. I mean, the one example which comes to my mind straight away is of Mr. Puri, okay, who retired from the SDFC. So his encashment was over 2,000 crores.
Oh, that's right.
Okay. So ESOPs have been a source of creation of a wealth, which normally for an employee is not possible. Let me tell you this.
Okay. Dipesh.
So I have similar view like Mr. Jain. Nowadays turnover of the employees are too much. So to retain the creative talent with the company and to create wealth, this is the only tools in the company's management hand. Yeah.
Okay. Sanchit.
So ESOPs are a very great way to attract and retain the right talent. And in today's time, as we see India burning towards a startup culture, it is very important for people to be stable at one place and innovate and not be distracted and move. So that is why ESOPs are a very right way to keep the engagement of the employees at the right place, make their alignment of the goals of the employees as well as the company in sync. So in that sense, ESOPs are a very great method to keep them together.
Okay, Moini.
ESOPs are not now a new concept in India. The regulators is also accepting the ESOPs as one of the route of compensating them, their employees. Even the RBI, the PSUs all have the ESOPs as a part of their variable component. So I think now the ESOPs will become a kind of a permanent kind of a perquisite, which in all the salary of components or CTC of an employee as a part of a variable component. So I'm seeing the bright future for the ESOPs now.
Okay, Moini, I will request, because when we are organizing programs, we are getting so many ideas. Whatever schemes you have designed, come out with a compendium. Take the views of the management, take the views of the employee of that company, and the statistical analysis of each page of dedicated to each company, that this company has started this scheme, what they benefit, and how the management is feeling. The ESOP in India will grow up. Thank you very much, friends, Jain sir and Deepesh. You have this program, and Jain will definitely be a milestone in our knowledge sharing initiative. And I will request Mohini to share books immediately to Deepesh and Jain sir by courier today itself. And all the participants, they can.
Yeah. All the participants can please share your request for the book through the email or any kind of a phone, even you can call us and can share us the request for the books. Yeah, please. I think there is some with the sir. So we will be today's webinar we are concluding, and thanks to everyone. Thanks to all participants, and thank you. Thank you.
Thank you very much, Mohini. Thank you, Veer Pawanji. Thank you, Deepesh. It was nice meeting it to you, and we will stay in touch.
Yes, sure, sir. Thank you. Thank you so much, Mohini ji. Thank you, Sanchit, and thank you, Corporate Professional. So such a wonderful opportunity.
Thank you.
Sure. Thank you. Thank you.
Thank you.
And thank you, participants. Yeah.